Morning, everyone, and thank you very much for joining me. This is the morning market review with myself, Russell Shaw, senior market specialist at FXCM, and my email address rshaw@fxcm.com. Today is Tuesday, it's the 23rd of August, 2022. Just going to bring up the high risk investment warning. I'll keep this on screen for a few moments. Howard, did you get all your emails today? Just let me know if you got the emails. We didn't have a webinar yesterday. I beg your pardon. Actually had a function in the morning, which kind of sprang up on me suddenly over the weekend. So I'm begging your pardon. Hey Anna, yeah, feeling a lot better. Still a little bit congested. I don't know if you can hear or not. I'm sure I'm a little bit nasally. I'm nasally on the best of days, but I think I'm more nasally. But I'm feeling a lot better, yes. Thank you for asking. All right, let's bring up the market commentaries disclaimer. Hey, Indran. Good morning to you. Nice to have you in the webinar. Just to let you guys know, we are going to be doing that day trading webinar starting on the 22nd of September. It's going to run for 5 weeks. It's very much similar to what we did in the US Open webinar. So we're just going to kind of package that into a 5-week program. You'll get emails for that not soon, but in the next few weeks. Here's our references. I'll keep this on screen for a few moments. Hey Howard, just want to double check. Did you get your emails sent to those right addresses now? Just want to double check. Okay, cool. All right, good. Let's just start off with the CNBC morning note. It reads as follows. European markets set for slightly lower open as energy growth fears take hold, euro at 20-year lows. European markets are set for a slightly lower open on Tuesday, tracking global sentiment as a fresh surge in European energy prices deepen fears of a recession and sent the euro to 20-year lows. Benchmark gas prices in the European Union spiked 13% overnight as damage to a key pipeline system running oil from Kazakhstan through Russia and into Europe disrupted supply. The damage comes after Russia said it will stop gas supplies to Europe for 3 days at the end of the month due to an unscheduled maintenance order on its main Nord Stream 1 pipeline. The euro sank back below parity with the dollar to notch a two-decade low and was trading around 99.15 shortly before markets opened in Europe. Asia Pacific markets retreated on Tuesday, taking cues from Wall Street after the US stocks closed out their worst session since June on Monday amid mounting concerns about more aggressive monetary policy tightening from the US Federal Reserve. US stock futures were fractionally higher in early pre-market trade, looking to arrest Monday's broad-based sell-off. Investor focus this week will be on the Fed's economic symposium in Jackson Hole, Wyoming, with Chairman Jerome Powell set to deliver a speech on Friday addressing the central bank's approach to taming inflation. So that's important. All eyes on the Fed chair on Friday. Back in Europe, investors will be keeping an eye on August flash PMI readings out of the Eurozone. Okay. Let's just go through to this chart here, which is again looking at real rates. We're looking at the dollar. My key focus is to see how markets are reacting as real rates start moving. And that's really what we're going to focus on this morning, I think that the market's actually cleared up to a large extent. A lot of the fog, I think, has lifted. Again, I'll sort of tag on that subject to correction, but I think that the pullback in the real rates really kind of introduced that that fog, and it was hard to kind of see through that, because it introduced a complexity or an ambiguity into the market. What complexity, what ambiguity? Well, rates coming down is a loosening of monetary conditions. And the confusion is, well, the Fed doesn't want loosening, it wants tightening. So the narrative that emerged from that is that the market saw a pivot in the Fed's approach to its monetary policy, and then it focused on all the little bits of communication that seemed to support that and kind of lifted it out, and that's what we read about in the media. But of the opinion that the tightening cycle is not done yet, and these pullbacks that we're seeing in the real rate or the dollar is actually no different to our approach that we've been following for the last few years now. So our approach is simply to look at the pullbacks and see if we can exploit them. Okay, so we kind of just look at these pullbacks. Just look at the pullback. So here was the latest pullback in the real rate, which rippled through to other market instruments. And it looks like that pullback is now completed. And it looks like we've gone into the next impulse. The trend is up. The primary trend is up in terms of rates because of a tightening of conditions. This is what we want to focus on this morning. So we go back to this over here, and it's very easy just to add a let's make it an ellipse right here, just in the same vein as the as what I drew on the on Microsoft Paint. Let me just get an ellipse here, big hills. And the question is, well, we don't know how far this impulse is going to run. That's the question. How far have we got? But it does look as if the correction has effectively ended. How do we measure the end of these corrections? Well, we've got, I think, a very good method, and it's these reference candle reversals, which we've again been emphasizing for, I think, a few years now, because I think that they work. Now, a reference candle doesn't guarantee a large swing, but of course you can't have a large swing without those reference candles. So what are we looking at here? We're looking at a candle that's got the lowest low in at least 3 candles. So if we go back to, so we're looking at a weekly chart. So if we go back to the candle from 3 weeks ago, you can see that this is the reference candle. Then what we do is we draw in a horizontal at the reference candle's high. So condition 1 would be the lowest low. Condition 2 would be price moving above the reference candle's high. And then condition 3 is the most important. It's got to close above that reference candle's high, and that completes the correction. Again, there's no guarantees. Okay, it would be quite acceptable for the market to chart a lower peak and push down if there was some sort of fundamental change, which of course this reference candle here wouldn't foresee. In other words, what I'm saying is we want to try and match the technical signals with the fundamentals that are unfolding, and hopefully we can make a sense out of the fundamentals, because then I think the technicals become a whole lot more powerful. So the idea here is that we've got the real rate now locked in. Last week's candle, although not quite a candle to write home. In other words, it's a very short candle, but it does complete our three conditions. And perhaps what we can say about the short candle last week is that there was still perhaps some sort of ambiguity in the market, but we are moving above this trough. The dollar, on the other hand, well, that didn't hold back, did it? So you had your reference candle coming in a week later, okay? You had your reference candle coming in a week later. Here is the reference candle's high point. And then last week, just an absolutely rampant dollar closing firmly above it. And it looks as if money is now starting to rotate back into the US dollar after a pullback of about 4 weeks. So why is money rotating back into the dollar? Well, I think there are two aspects to this. Two broad aspects, and the one would just be the one aspect would be monetary policy, Fed monetary policy, and underneath that we would throw in the fight against inflation. And then the second category that we could throw in that is probably supporting the dollar is just general macroeconomic fundamentals, global macroeconomic fundamentals. What do I mean by the global macroeconomic fundamentals? Well, Europe, borderline recession. UK, double-digit inflation. And Citigroup, I don't know if you guys saw yesterday, there was a report out of Citi yesterday suggesting that UK inflation could hit 18%, 18% next year. Now, I find that hard to believe, but you know, that's from a very obviously big reputable powerhouse in the financial market. They see 18%, but that's I think driving money into a safe haven. We've got the geopolitics, Ukraine, but not only Ukraine, Taiwan's come into the picture. So there's some saber rattling there, driving money back into the safe haven. And together, I think the Fed plus the geopolitics, so those two sort of categories, very much, I think, being supported by technical signals here. We'll carry on, of course, watching, but you can clearly see that there is a reference candle reversal in both of these. Now, let's just stick with the dollar. Okay, I'm going to come back to the real rate. I want to, because I think that is a key focus for us. But I want to just show you something very, very interesting that we do need to take a look at. And again, so this is one of the most important factors that are driving the market, and probably the one that is mentioned the least. What am I talking about? And that is this quantitative tightening. So let's just take a look at that. All right, so the ticker code I'll look at is WALCL. Okay, this is the Federal Reserve's assets. Okay, let's bring that up. And we're going to look at this on a weekly basis. And let's get rid of this. All right, so you can see I was looking at it yesterday. I'm going to move this back to that point, this point here. All right, so this this dashed vertical line here. Okay, this dashed vertical line here is the week of the March minutes. The 14th of March was a Monday, so 2 days later, the 16th of March, we had the, not the minutes, I beg your pardon, the FOMC statement. And that was the first time that they acknowledged that there was going to be quantitative tightening. Okay, and since then, well, you can see that the Fed's assets have started to reduce. Okay, so you can see that. So we're close to 9 trillion. We're coming down. By the way, the Fed's not going to meet. You know, it's got its target for September of 60 and 35 billion. It's not going to meet that 35. They're going to be short there, just for September. But we'll keep an eye on that. Let's add in a correlation coefficient here, because this I think is going to drive the point. Okay, so let's add that in. Getting ahead of myself there. Let's just put it in. Okay, so this is fascinating. So you can see from the date of that statement how the correlation coefficient now has inverted. It's gone from positive to negative, and that makes sense because the fact of the matter is quantitative tightening is taking liquidity out of the market. When I say liquidity, it means it's taking dollars out of the market. They just, the Fed's taking those dollars, popping it in its vault, not to be seen until they release it. Well, if there's less dollars floating around, it's going to support the dollar. It's going to make the dollar more valuable. So we would expect that as the assets come down, and they will come down according to that statement, well, I would expect the correlation coefficient to stay negative, and we've got a very robust minus 74 here. So these kind of pullbacks in this type of environment, these kind of pullbacks, okay, just use our ellipses, right? They become very compelling. So we get right, we get these ellipses. We get these periods of fog, and I don't know about you guys, you know, but my emotions kind of get very much sort of caught up in the market ambiguity. But in the longer term primary trend, it's actually unfolding as one would expect, isn't it? So I think we just carry on watching this. And the idea here is we're tightening. So any kind of message of loosening, I think we've got to come back to this type of relationship. The Fed also pretty much is, they're going to manufacture the recession. I think in their last communication in the minutes, they're okay with manufacturing that recession. And that's also, I think, what the market is now starting to price in again. Hey, okay, Rob, cool. No worries. Just will you mind just sending me an email? I'll follow up on my side. So how high can the US go before the ECB steps in? I think that's the question there. Yeah. All right. So I think that is, of course, something that is worth taking a look at as well. Let's bring up this guy here, which is the baseline, just to get a broad view of what's going on, sort of on the market side. And of course, the chart on the left, this is just a 4-hour chart. This is my US dollar. And the US dollar is moving in that northeasterly direction. Well, here's the euro moving southeast. By the way, I closed my euro position yesterday, but I look to get back into it, right? Pound moving sort of southeast, Aussie southeast, US Canadian moving northeast. Well, that makes sense because the US dollar is the base currency there, whereas on the top three it's the quote, right? That makes sense. Bitcoin to US dollar, we're not going to get too much into it. Moving southeast makes sense, right? US dollar Swissy moving northeast makes sense. US dollar Japanese yen moving northeast. Okay, it makes sense. We'll come to DAX and Dow in a moment because we have to talk about those. Oil, I think we'll come to in a moment. Gold moving southeast. Well, that makes sense because US dollar is the numerator there. So you can see these are all moving in the direction. So the question is, well, when does the ECB step in? And I don't think it makes a difference. This is a bold statement. I think it's a bold statement. I don't think it makes a difference in the longer term. It will introduce, of course, immediate volatility, short-term volatility. But I think that with the Fed, there's just no, as they say, no, don't fight the Fed. Is just too large. They're unwinding $9 trillion there, Rob. It's a tsunami. And if you take a look at the Bank of England, which has been raising rates over the first half of the year, it hasn't done much for the pound. The pound is still capitulating against the US dollar, and that's despite now a Citibank report of 18% inflation, which will have to be controlled via interest rates. So I don't think that it will make a difference in terms of the primary trend. I think what will make a difference in the primary trend is when the real rates switch. I think when the real rates switch. So I think the mechanism is actually on the US side. If there is any sort of force that kind of does exert influence, well, I think at the very best, it kind of then just flattens the decline of the euro. It kind of, we find some sort of sweet spot. But I think that the dollar here is a wrecking ball. So that's the way we've got to, well, we don't have to, but I think that's the way I am sort of looking at the market, because this over here is actually an absurd, to be quite honest with you, it's an absurd economic environment we're finding ourselves in. What do I mean an absurd economic environment? It's completely abnormal, okay? You've got this spark up here from the quantitative easing due to lockdown. This, by the way, just feeds into inflation. And then, of course, well, I'm not sure how quantitative tightening is going to impact the market in terms of side effects. But this over here is an abnormal monetary policy. It hasn't been utilized all that often, and certainly not to that degree. And now the Fed's trying to correct it. So we've got 9 trillion here that's the Fed's trying to take out of the market. How does the ECB compete with that on a sort of primary trend basis? Maybe on your sort of short-term volatility, which will probably be tradable, I would imagine. But we just find ourselves in this absolutely like it's just a very difficult market to fully comprehend. Another relationship just to perhaps keep an eye on. If we're going to get this drawdown here, if we're going to get this normalization in the balance sheet, then of course take a look at gold. So I was having a discussion with my dad yesterday, saying, well, what about sort of recession? Won't money automatically flow through to gold? Because I think that's what he's used to. And of course, it might. I mean, the idea here is, of course, it might. But my personal opinion, and this is subject to correction, is that it won't. And the reason it won't is because we're in this absurd environment. So if I change this US dollar to DXY, right? So go through to DXY, which is the US dollars, a trade weighted dollar index. And the reason I'm going is because we have a much longer history. We can see some very interesting relationships here. So let's add in gold underneath. All right, and we'll just add in a correlation coefficient. And what I found very interesting was that, just take a look how the inverse relationship between gold and the dollar is dominant. Yes, there are times, of course, when we have these spikes up, but by and large, the inverse relationship is dominant. And what that implies is that the absurd sort of, the absurd environment we find ourselves in because of just this flood of liquidity, well, if this correlation coefficient holds, and I suspect that it should, because the US dollar is still the denominator, 1 troy ounce valued in gold. Well, if we're going to have a strong US dollar, well then gold, I think, is not the safe haven that it once was, because simply the dollar seems to be where the price adjustment is taking place. Right? That price adjustment, is taking place on the dollar side. And it's just asking, what's the red rectangle? I'm just pointing out that it's closest to -1 here. So just to, sorry, let me just explain that. So we've got 3 levels that we look at in terms of a correlation coefficient. We look at 0, okay, which means no correlation. And then we look at +1, which is complete positive correlation. And then we've got -1, which is complete inverse. And you can see that they tend to move inverse to one another over time. Again, makes sense, 1 troy ounce over US dollar. So I'm just saying, look at it since 1972, and how long did it spend close to -1? And the truth is, the majority of the time, it was at -1. Well, if that's the case, and we are sitting in this environment where now there's an unwinding of the balance sheet, and the market is still adjusting for that, well then the dollar over here, I think, still has plenty of room to move. It doesn't move. It doesn't mean it goes in a straight line. It can't go in a straight line. There's going to be ebbs and flows, ebbs and flows. There's going to be these weeks of fog. I think we can expect that. But by and large, when we're looking at such a big correction in terms of monetary policy, then the idea here is it's going to have ramifications. By the way, just something that's interesting. Let me just show you this. Can't remember what this is called. I think it's called. It's called the Fisher equation. So there's an equation in in economics that goes like this: price. Sorry, goes like this: money supply. So this I'll just put MS. Velocity of money equals price, and what they call it Q. Okay, Q is quantity, it's GDP. So let's just put this in where MS equals money supply, V equals velocity of money. I'll tell you what that is in a moment. E is general inflation. And Q is GDP. Okay, so according to this equation, velocity of money and GDP is generally sticky. Okay, so and I think you can debate that. By the way, the velocity of money has changed. What is the velocity of money? It's just how, for every dollar note, how many times does it change hand? That's called the velocity of money. Okay, so the monetary school of economics assumes a constant velocity of money and assumes constant GDP. And what it says is when the money supply increases, okay, to keep the equality, the adjustment takes place in prices. Okay, so what it's saying is that a increase in money supply is generally going to increase prices. There is some validity in that, but there is some problems with this equation. But I think where it helps us here, okay, where it helps us here is, well, you go back to the money supply here. Okay, well, in hindsight, obviously, and if we had to use the quantity theory of money, I think that's what's called the quantity theory of money. Well, then there's obviously a very clear reason why we have huge inflation. Okay, because the adjustment for the liquidity is taking place in prices. So that's kind of what's happening now. What the Fed is trying to do, of course, is reverse that. What they're trying to do now is they're trying to take money supply out of the economy and move prices down. Okay, so that's kind of what's happening at the moment. Currency reset. If dollar keeps strengthening, if recession across the world has a duration. Sorry, Gertie, just expand on that. If recession across the world has duration. And it's also just saying how high the dollar can go. Well, the truth of the matter is, and I don't know how high the dollar can go. I don't know if we're near its apex. I suspect we're not near its apex. But again, we're kind of in this weird environment that there's no real precedent. We can probably go higher, one would expect. So we just want to keep an eye on that, right? Look at 1985. Okay, let me just go back here. Okay, so here, of course, I think this is what you are referring to, Gertie. I think this is what you're referring to. What we can also do here, I beg your pardon, it was Anna that wrote that. It was Anna, okay. When the dollar gets too strong, it damages the US economy. I see what you're saying, okay. All right, so instantly, one more thing here before look at Gurdeep's point. Let's just add in the Fed funds rate. Fed funds. Let's just take a look at 1985. Okay, it's interesting here. Okay, well, there the rates will come down. I'll need to think about this. It's very interesting. So this is after, by the way, this 1985, this kind of pushed down here. What kind of moved it over here? I think the idea is not really sort of this side of the parabola. I think this is the interesting side of the parabola. Okay, because this is now straight after the 1979 second oil crisis, right? So, and there's Volcker's move over here. This is Volcker over here. So, and you can just see the rampant dollar there. And of course, we get there's a little bit of an anomaly here. A little bit of an anomaly here with gold. But the point being is that I think that the point being this balance sheet runoff, I think we must just be on top of that. Now, let's just take a look at a few other things here, and then we'll see if we can make some inferences in terms of positioning ourselves as traders. Let's start off with the US 30 and try and link that with Gurdeep's last comment, which was when the dollar gets too strong, it damages the US economy. I'm going to have to think of that. I want to just think that through, Gurdeep. So I'll just tell you sort of immediate thoughts that come to mind just as I try and think this through. The first thing is, of course, the US has in the past followed a strong dollar policy. So I don't think that is unusual for it. The stronger US dollar at the moment is actually probably beneficial for the US, and it is completely detrimental for the rest of the globe. So the reason for that is because commodities would be priced in dollars. So a stronger dollar would offset any commodity inflation there. Where in the rest of the world, the higher commodity inflation and a stronger dollar is almost like a double jab, isn't it? It's like a punch to the gut. So that's happening. I think that we can say that. We also can say that any emerging market debt is held in dollars. That's going to come under pressure. It's just those are the first things. The other thing that we can say, of course, is that the US is not really an export-focused economy. Sure, there's an export sector, but it's mainly an import and a service-based economy. So in high inflation, strong dollar actually serves them remarkably well. I guess there will be a point, where the export companies on the S&P are going to complain and all that. I'm not sure the Fed is too concerned with that at the moment. So I think those are just thoughts. I've probably got to think about it in a little bit more depth, but those are just the sort of items I think we've got to consider. If we look at terms of trade, there are terms of trade in here. I'll see if I can find them. US terms of trade. So this is basically just looking at export prices versus import prices. What's actually quite interesting is that the US terms of trade are actually doing remarkably well. See, they've picked up. Whereas a country like Germany, which has now got the benefit of a lower euro, is actually not benefiting from that. So if we take a look at, let's see if I can find Germany's terms of trade here. It's getting hammered, which is odd. Yeah. So there is a there's a real kind of I don't want to say dichotomy from conventional wisdom. It's not quite like a break from conventional wisdom. And this, I think, by the way, is probably a side effect. It's probably a side effect of that quantitative easing, which was irrational. So now the question is, does quantitative tightening rein in those side effects, or does it create a whole host of other issues that we're going to have to deal with? And of course, that is, we're just talking here about one aspect of the Fed's policy. We're going to have to look at Jackson Hole now on Friday to see, well, how aggressive is the Fed going to be with their normal monetary policy, with their interest rates. And of course, the market is not too thrilled about that either, because of the inverted yield curve, right? Which is something, again, to keep an eye on. It's actually, it's sort of flattening out a little after yesterday, after last week, I beg your pardon. But you know, we just want to keep an eye on this. So recession, very much, I think, still a risk, and the Fed, I think, is sort of actually even trying to manufacture that, which of course now brings us through to the US 30 and the DAX. So let's just go through to the Dow. And here is the so I'm just reading a comment from Gertie, very clever. That's funny, yeah. So look, we've got this pullback in the US 30. Again, something for us to keep an eye on. Are we going to get a correction here that is something that we need to concentrate on? We'll have to wait and see. But of course, there is the possibility of even further declines. In other words, this may be a bear market rally. Now, just looking at the Dow Jones here, I'm actually finding this a very again hard. It's a very difficult chart to analyze, because the peaks and troughs, which determine trend, are not clear. In fact, we don't have any peaks and troughs which suggest a trend one way or the other. So even if we get a pullback here, I think that this kind of pattern will be very detrimental, because then we get a lower peak here, lower trough. So there's a lot of permutations here. See, even if we get the higher trough here, we still need to take out this higher peak before we can say that we are trending up, but we may get this lower peak. So what does that say for us right now as we trying to establish market direction on the US 30? Well, there is no market direction. Although I feel that the fundamentals, to me, seem to be suggesting still an applied pressure. The technicals haven't quite lined up. It's not the same as the DAX. The DAX, the technicals have lined up. Okay? The DAX does have those. You can see that the DAX doesn't have the problem yet. We've got the peak, trough, lower peak, lower trough, lower peak. I think we can take this question mark out probably next week. We just want to keep an eye on it. I want to see the reversal reference candle just lock in. And then will we get the next lower trough? Well, we looked earlier, the terms of trade for Germany not looking particularly healthy, despite this real value that's emerging in the euro. And I think that's suggests how close the euro area is to that recession. And what we can do is, well, we can take a look at the daily chart here, and we can see, well, we're now in zone 3. Zone 3 is, of course, our bearish area. Take a look at the stochastic. So the momentum building to the downside. We've got a little bit of a buying tail here. Well, that's interesting. So now we're going to go through to the hourly chart. Okay, now we go through to the hourly chart, and we're getting this rally. Well, now we're getting a rally where we've got a long-term downtrend, where we've got a zone 3 weakness, where we've got bearish momentum building up. Well, central pivot R1 all of a sudden become very, very interesting, I think, for potential bears. So any sort of rally into the central pivot, into the R1, I think are very suspicious. And then we can see if we can take advantage of that. That was my thinking, by the way, in terms of euro yesterday. So I exited because we went oversold. I've been holding this for quite some time, the short position that I exited. But I'm going to see if I can get in on some sort of rally. I'm going to see if I can get back into it. You can see that the momentum is predominantly down there, isn't it? You take a look at something like gold now. So we're going through to the shorter term charts, and this is looking really interesting. Okay, so you go through to the weekly chart here. It's been absolutely obliterated. Lower peak, lower trough. This is no longer a question mark. I'm not sure why I haven't changed that. That's a lower peak there. Okay, here's your lower trough. Okay, now this I think is tied in with the dollar story. So we want to keep on top of that dollar story. This looks like the lower peak, and then we go through to our zone analysis. Well, take a look where the momentum is. Okay, it's right down. Take a look at our signals here on gold. So this is looking like it's starting to get very interesting. We've got the triggers here. I think that the EMAs still need a little bit more angle and separation, but I want to get this. I want to get the. So I know Anna says, but Anna's asked previously. I beg your pardon. Will we miss if we wait for it to go into to the extreme? Remember, Anna, that's not the methodologies. Now we're getting the triggers, but it's not going to pay off until it gets here. That's the sign that the momentum has built, but the signals come in earlier. But there's no guarantee until we get the momentum holding. Okay. Once we get the momentum holding, that's where the swings. That's in the midst of the swing. Okay. So you can see gold now is starting to look very interesting, looking very fragile at that central pivot. We're going to keep an eye on that. Just one last thing. I want to just go back to the US 30 here, which I'm finding quite. You know what? Let's go through to NASDAQ. It's easier on NASDAQ. Okay, so you don't have You don't have the lower peak here. You've actually got the higher peak. But I think that this Nasdaq here, I think that this is looking very dangerous in my estimate. Although we don't have a lower peak, I think that the higher rates, okay, the higher rates. So now we're shifting from technicals to fundamentals. The higher rates are really going to rotate money out of the Nasdaq, out of the growth area, because of the function of the time value of money. Yeah, so Rob's asking about silver. I think, yeah, we'll look at silver tomorrow. It's I have traded silver, but not often. It's not one I have looked at it's not one I have looked at lately. But I would suggest that the dollar would affect silver. It's priced in dollars, so I think it would affect it adversely as well, Rob. So let's take a look at that perhaps tomorrow. I'm just cognizant of the time. But just before we do go, let's throw in the time value of money. Just to understand, so we've looked at the technicals, but let's just understand the fundamentals that are driving the market. And it comes down to interest rates. Okay. The theory is that interest rates, okay, are something that we can all get access to pretty easily at the very sort of with the least effort. We can move into a savings account, and earn some bank applied interest or something. But in order to entice us to go into something that's more risky, well, we have to have the opportunity of earning that interest rate, plus we need a premium, because we are assuming more risk, plus we need a premium. Okay, so if we're looking to go into the stock market and it's looking like a bear market, well, we're going to require a higher premium. Okay, if you want me to invest there, Mr. Broker, well, I need a higher premium. So I think premiums are in flux. Okay, because the markets are still very uncertain, but I think interest rates are in flux as well. So these are both moving up. So how does that? Where's the risk in that? So here we've got current share prices, okay, equals dividends or cash flow divided by 1 plus interest. And there will be an exponent, but we won't put the exponent in. The exponent is dependent on time. We don't have to put that in. All we have to know is that interest rate, that R, includes the premium. Okay, so this R over here, would be interest rates plus premium. Well, if they're both moving up, well, that's giving more power to the denominator, because it's increasing, right? Well, if the denominator is increasing, well, then the current share price is going to be under pressure. So we'll just make it a very simple example. Let's just say the dividend is 1. Let's just say your current interest rate is 2, or 1 plus I, let's just call it 2. Well, then your current share price would be 0.5. Okay. Well, let's just say that the interest rates and premium push up, so we've actually got 1/4. Well, you can see that your current share price is dropping to 0.25. So if these are in flux, okay, then there's going to be a pressure here. And if there's a pressure here, okay, well, then these rallies are suspicious, and that's what we're looking at. All right, just cognizant of time, I think we can wrap up here. Any questions, please go ahead and type those in. Any questions, please go ahead and type those in. Tomorrow we will have 2 webinars. We'll have the morning market review, and we will do cryptos as well. All right, nothing coming through, so let's wrap up here. Thank you very much for joining me this morning, guys. Have a good day, good evening, and we'll chat tomorrow morning.